Good afternoon and welcome to the FFTC Mid-Year Investment Webinar. My name is Stephen Berard and I'll be representing the FFTC investment team today. We'll be joined by our great partners from Mercer, Tim Westrich and Travis Pruitt. We have some great content to share and cover, impacting some key themes such as concentration in the markets, alternative investment performance, and consumer confidence. It's been another strong start to the year. I feel like, I keep saying that after 2023 and 2024, 2025. And now again, we have kind of, a blip in the spring with the war in Iran, and markets went up almost 20% from that point. And I think the second quarter was the best quarter for the S&P 500 since 2020. So we're having a great year, and really excited to share the content with everyone. And I'll pass it to Travis to kick us off.
Excellent. Thanks, Stephen. And
Yep.
welcome back to everyone that's joined us before, or if you're new, welcome. We will go through a few items today. So we'll talk a bit about the market environment through the second quarter of the year and the year-to-date period. We have made a couple of changes in the portfolios more recently, so we'll give you a quick recap of that. And as always, we will review the standard pool performance from a big picture level, and then of course take any of your questions. If you have any questions, do feel free to put those into the chat or into the Q&A box, and we will be happy to address those as we go. So maybe if we start with the quarter. So to Stephen's point, it was a really good start to the 6-month period. So if we start up here in the upper left-hand corner, I gave a gold star to equity market performance for the first 6 months of the year. Growth in equities has been really pretty tremendous. Off to a little bit of a rough start in the first quarter, but that bounced back at the end of March, even with the notions of a war in the Middle East, a renewed war in the Middle East. The volatility has been high, so you can see there's a lot of jaggedness to these numbers through the course of the year. But the big takeaway is that the market has continued to be ebullient. Market participants continue to look past some of the near-term risks or potential near-term risks, whether that be in the form of geopolitical risk or other notions. And much of this growth is really driven off the same central theme, which is the AI theme, and we will talk more about that as we go. But again, gold star for equities. In a risk-on environment, though, we did see rates rise a bit, right? So the war typically brings the notion of at least short-term inflation, higher inflation. That's generally an outcome. Excuse me, and certainly when it's associated with the part of the world that generates an awful lot of oil, the price of oil goes higher. Oil is in virtually everything. And so we did see rates rise as investors took into account that perhaps, at least in the interim, inflation might be higher than expectations. And so that caused the 10-year Treasury to go from, call it 430-ish, in the range of 430 to into the 440s in the second quarter, and even since the end of the quarter, as high as in the high 460s to almost 4.7%. So we have seen the yield curve steepen. At the same time, we did see just out of my way so I can see. Sorry, the yield curve flattened a bit in the short run. So we saw spreads between the 10-year and the 2-year contract, and we saw spreads between the 5-year and the 30 contract, and we also saw corporate spreads continue to contract. In fact, contract quite a bit. So you can see, the starting high yield spread and the starting investment grade credit spread. Really, it was a good time to own corporate securities. In fact, even in rising rates, as we'll see in a minute, the spread contraction and the level of yields actually allowed for modest but positive returns for fixed income for the quarter. At the same time, we saw the dollar rally, perhaps not surprising, as uncertainty increases in markets over time. There can be a flight to quality, but you see it's been pretty volatile. It came out, went down, came back out, but that has helped. And at the same time, we saw gold and oil fall. And in fact, that those are perhaps not completely unrelated, as both of those commodities are primarily priced in US dollars. So if the US dollar goes up in value, all things being equal, these might come down. But certainly the on again, off again ceasefire and activities going on in the Strait of Hormuz currently has put some downward pressure at times on the goal on the oil price, particularly, you can see it over the course of second quarter. It's bounced around a bit. That still is an issue that remains to be resolved, and that the process of resolution will periodically add some volatility. But participants have, at some degree, taken a longer view, as well as there's some technical factors that the Chinese have proven to be much more flexible with the use of their strategic petroleum reserves, their ability to actually reduce their consumption of oil from current markets, which has also helped to not allow oil to maybe run roughshod as we've seen uncertainty grow. So it was, lots of cross currents, but all in all, not a bad quarter. So when we look at that equity drivers, that gold star translated into almost a 15% return for the second 3 months of the year, and over the trailing 1 year period, you can see the numbers are really pretty solid. The market has broadened out. So whereas, as Stephen noted, markets have been really pretty strong since the end of 2022. Much of that leadership, and particularly in the call it the last, through the first quarter of 2026 for the 18 months prior to that, it was really primarily driven by U.S. large cap stocks. We have seen broaden out with some interesting characteristics of those returns that we're going to look at. But a 20% return in a quarterly period is pretty amazing. That's a really good year, let alone getting that in a single quarter. So the bounce back from some of the volatility in the first quarter has been substantial, and it's true not only in the U.S. but also in emerging markets. But again, some central themes going on in these asset classes. If you look at the top of each of these indices, AI or AI related entities are really at the top of each of these asset classes. So there is an underlying theme throughout the global equity market, driven in large part by this capital expenditure and this growth and use and development of AI. And we see that across indices, and that had some impacts on active management, and it also has some impacts as we think about risk management. We'll talk about more about that as we go. As I mentioned, even though rates rose at the margin, we did see positive returns in large part because credit spreads did contract. And so that helped push returns higher for the U.S. credit index. And that's credit is about 30% of the Bloomberg U.S. aggregate. That did help push returns higher. And then again, coupons are higher than they were 3 and 4 years ago, 4 and 5 years ago, I guess now at this point. And so, we did get some actual coupon interest in addition to even with some short-term mark-to-market losses. The big winner in global fixed income markets in the short term this year has been emerging markets global debt. The spreads there have been attractive. The emerging market arenas have been much more attractive and have shown some resilient growth. And so that was the short-term winner in that space. And we have a little bit of those exposures in high yield leverage loans and in emerging markets debt, very small, collectively less than 20% in the fixed income allocation for most of the pools. We'd like to have a little bit of exposure there so we can take advantage of some of these opportunities when the returns are stronger. When we look at the more diversifying assets across the alternative universe, outside of private or public natural resources in the more listed markets, publicly traded markets, hedge fund portfolios performed really pretty well. The more diversified, slightly less aggressive strategies in this fund of funds diversified underperformed the broader hedge fund universe. There are a number of funds that hold a hedge fund moniker, but that are much more directionally oriented towards equity markets. So in environments like the second quarter, as you might imagine, if you own more equity exposure, you're going to perform better. So we did see that a little bit, and that had some impact on the portfolios, and we'll see that as we go. But really pretty solid performance, and this natural resources number is perhaps not surprising given what we saw in oil on the previous page. When we look across private markets, quarterly numbers are not terribly meaningful because they are a little bit lagged. We get a little bit better information out of the trailing 1 year numbers. And for the trailing 1 year numbers, these are solid absolute returns. Perhaps they feel a bit paltry in an environment where equity markets have posted really tremendous short-term results, but these are the kinds of, we can average these kinds of results over time. We think uh, these will more than demonstrate the value to the diversified long-term growth portfolios that these private markets tend to sit in. So again, really pretty solid performance across those private markets, commodities which do trade in the short term. Perhaps not surprising, a similar outcome as the stocks that traded around natural resources as well. So lots of good news, lots of green on the page for the quarter, and some interesting stories to go along with that. So we did a deeper dive more recently on just what's gone on with this AI theme, and what types of impacts is it having on market benchmarks, on diversified portfolios. And we thought this was a great topic to spend a few minutes on today, because we have experienced some historical differences in the short term in some indices than we have previously. We've talked a lot about it in the S&P 500 and amongst US large cap stocks. Excuse me. But the smaller market indexes, like in the US, have been largely immune to severe concentration until just this year. And so we want to talk about that a little bit, because it's historically important, and it has some real impact on, as you read the financial press and as you hear about what's going on in markets, it's important to understand what's going on under the hood. So prior to June reconstitution, which happened just a few days before the end of June, if I take a half step back, the Russell indices have historically reconstituted once per year. That is, they basically strike their list of companies that are in each index. So in this case, the Russell 2500, which is one of our sub benchmarks for our US equity strategy. Russell applies their rules, and they get a list of names that will sit in the Russell 2500 index over the course of the next 12 months. So the last time they had reconstituted was June of 2025. And they do it just before the end of the quarter, so that coming into the quarter, those passive portfolios that track it have the opportunity to reconstitute and get launched. But as you can see here on our chart on the right-hand side, prior to the June reconstitution, the top 10 names in the Russell 2500 index were 9.7% of assets. And that's the top 10 percentage allocation is what this blue field represents. So you can see, relative to history, it's been almost 30 years since we've seen this level of concentration. In fact, this is historic level of concentration of the top 10 names in the index. The February of 2000 was a prior high watermark, and many of you will recall that is just after the turn of the millennium, and just before we saw technology, media, and telecom stocks that had ridden the wave of the internet boom and the Y2K boom in many ways as well. We saw about 9% of the portfolio in concentration. Most of the rest of the time, this index is pretty diversified, which is one of the reasons it creates an opportunity for active management, is that there's a lot of diversity. There are a lot of names amongst smaller companies in the US. These are of the Russell 3000 index, which captures substantially all of the US investable marketplace. These are the smallest 2,500 companies. And that's a very diverse group. And generally speaking, it remains in the index as a very diverse group, where the concentration levels in the top 10 historically have been anywhere from 2 to 5%. So to have them really stretch to this level was an interesting moment in time, and it was driven by a really unique set of circumstances. So over that last 1 year period, we did see the index became notably more concentrated. Again, you can see it in the data here. The top 10, 2 to 3 times normal allocations. Really, it was a subset of very small subset of stocks in some ways that really drove this. One stock that spun out from another company early in 2025 was added to the index in June of last year at a weight of about 14 basis points, of 0.14% allocation. That stock, based on demand associated with these data center build-outs, their memory provider, grew to a 3.6% basis over the 12-month period. And this is a company that historically has been very cyclical, not particularly a great business over multiple cycles, but in this current environment demand went through the roof for their memory chips, and they grew to a size that is basically around 10 times the weight of a typical company. And so that has some ramifications as we look at performance and we think about the impact to diversified strategies in such a concentrated period. The other notion is 7 of the top 10 stocks were in technology. So not only did we have name concentration, but we had sector concentration. And if you're an active manager that diversifies your portfolio, you're typically not going to have that kind of exposure either to a name or to a particular sector. And as a result, it was very difficult over this period for active small mid strategies to outperform. Some did, but the benchmark itself was a top quartile performer, which suggests, and that's against all small mid strategies that we track in the U.S. And so that's basically 75% of active management in this period underperformed. So challenging environment, and one that has now been reset. So when we look at this in a little bit more color, that name that grew from 14 basis points to 3.6% was SanDisk. So again, this is a memory, flash memory type company. If you have a phone or you have a digital camera, you may have a little SD card from SanDisk. That flash memory and the technology that they have is in high demand today based on the data center buildouts. And so we saw that those names really go strongly. But if we look at that relative to the prior 2 years, we can look at the concentration into 2024, just prior to reconstitution, the top 2 names together were 1% of assets, and post-concentration, the top 2 names were a third. And you can see, while still some concentration in technology, which is the blue, more diversified. Definitely so after the reconstitution in 2024. 2025, again, only about 60 basis points of exposure, 65 basis points exposure between the top 2 names in the index. That's out of order. Robinhood was, a strong performer in the 2025, and then reconstituted back into a more diversified portfolio. So these index reconstitutions matter because it does change the opportunity set for active managers as Russell makes these changes. And now this June was the last annual reconstitution. Russell has made a change to their process where they will reconstitute twice per year. So the next reconstitution will be at the end of 2026. And so theoretically, these types of certainly 12 months moves, these names very likely would rotate out well before they reach that level, unless they just go parabolic. But it does have impact on thinking about active management and active strategies within U.S. small cap. And I think a key notion is the fact that when it comes out of the index, that the manager doesn't have a chance to catch up if they were right, if they were quote unquote right with their analysis. So an active manager felt that SanDisk, yes, lots of near-term demand. Yes, they're having a really good go of it right now, but as a long-term durable business, we don't like the dynamics. They've had struggles to make consistent profits. Whatever the argument is, we don't want to own 3.6% of anything in our Russell 2500 strategy. If the opportunity came up that they might ultimately be proven right, they don't get that chance to catch up against the benchmark. And that's a feature not considered often, but one that's important for us to keep in mind as we think about it, because it creates a little bit of a hole in performance. And we expect knowing these things, we expect managers to outperform over multiple cycles, but it is going to have some impact in some places in the short term. And in fact, under this notion of, I suppose you're right when you decide to pull out the measuring stick, but even since the end of the second quarter, as SanDisk has gone into the S&P 500, well, it's already in the S&P 500, the stock's dropped 40% since the end of the quarter. And so that 40% is not something that's going to impact the Russell 2500 index. And that's something that the managers won't be able to, if you will, again, catch up on. So we think that's an interesting nuance that's perhaps helpful to know and understand as we think about and plan for outcomes for your portfolio. Stephen, do you have a question?
Yeah, I feel like we've been hearing a lot about concentration, right, Travis, and definitely in the S&P 500. But I feel like last year it was, almost talked about from a fear angle, right? Like the markets are very concentrated. This is what happened, before the tech bubble, and we haven't really seen that sell off. And a lot of these top companies are the top earners, right, and keep beating earnings. Like maybe just a minute on, is concentration something to fear? Is it bad, or can it be good being market cap weighted versus equal weighted other ways to invest?
So I think it's going to sound like a wishy-washy answer, but in some ways it depends. So if we think about since the end of 2022, concentration's been good, particularly if you're a US large cap investor and you own the S&P 500, you've been happy as a clam to be concentrated because those 10, 7 to 10 names that have been at the top of the index in the US, they have been extraordinarily successful. They've generated huge amounts of earnings. Uh, Many of them have created huge amounts of demand for each other, and as a result, stock prices are up a lot, earnings are up a lot, revenues are up a lot. So yeah, there are times when concentration is definitely your friend. Uh, from a risk management perspective, though, the similar forces that can take you up can take you back down. And so when those top 10 names got to be more in the S&P 500 got to be more than 40% of assets, if this is not a forecast, just a scenario, but if investors don't like the pace of earnings development or even revenue development that goes along with all this AI spend, and they decide that, hey, we need to see more earnings before we're willing to bid these stocks up more, then you could see those names fall off pretty quickly. High expectation stocks tend to correct pretty meaningfully when expectations change. And so that's the flip side and the negative part. And fear might be the right word if you own too much of it. Right? We generally with the portfolios that we build with you and your team, uh, we have a meaningful allocation to U.S. large cap stocks. That's the biggest market in the world. We want to have exposure there. Those are great companies in general, and we do want to have exposure there. But the reason we don't own just that is that sometimes that doesn't work. And in an environment like this, when it doesn't work, it could really not work well. That won't be a, if the AI story breaks, or even if it pauses, that won't be only felt in US large cap stocks. It'll be less so here now today with the Russell 2500 and US small mid stocks because it's more diversified today. But if we'd have had a, meaningful AI meltdown in May, hiding in small mid cap stocks would have not provided maybe a tremendous amount of relative support. And when you look at like the emerging markets index and the names that have been at the top of that, SK Hynix, Samsung, Taiwan Semi, those are all related to the AI story. They've all really performed well as the story's gone up. And we've seen those correct quite a bit in some cases, since the end of the second quarter. And there's some technicals in that as well. But so uh, this level of concentration is different. I'm in my 33rd year of financial services, watching things like this. And over the course of my career, we've seen concentration, but it's been much more in sector than it has been in name. Now we have both. And so, yeah, the relative risks are probably higher than they have been relative to history, which is, again, why we want to make sure that we're diversified. We want to make sure that we're getting exposure to the stories that are working, because that's, ultimately you have to do that when you see this environment, but that we have enough diversification around the edges so that inevitably no tree grows to the sky, right? So at some point, these will pause, they will correct, there will be a re-rating of some type. Maybe it'll be modest, maybe it'll be a lot, we don't know. But that diversification is going to really come back to be important at some point in the future. So great question. Any other questions there before I move off of this? Okay, great. All right, so hopefully that was helpful to give you just a little bit of color what's going on under the hood of the markets. These are dynamics that we have to take into account and we want to consider as we evolve. So as we think about things to watch just a couple items have come up that I thought we were prepping for this that I thought would make sense and that were interesting. So when we think about opportunities and risks across the landscape, global growth is expected to be really pretty good. Uh, you can see expectations for GDP growth across 2027 and 2028. Some up, most up, uh, some flattish in terms of growth rates, but all in all, really pretty solid expectations for GDP growth. The economy in general is okay. It's being led certainly by CapEx amongst the hyperscalers, the amount of dollars being spent to build AI infrastructure is still phenomenal. And so, if you think about that question about concentration, if those come off, those levels start to come off, uh, certainly that will have some impact to GDP if those dollars aren't redeployed somewhere else. But certainly that's helpful. And inflation expectations are moderating, but perhaps above target in some places. U.S. inflation expectations for 2027, 2.2, expectation to be a little bit higher in 2028. It seems a tough road to hoe to get to the 2% level, but perhaps if we can stay below 3, those will be ultimately seen as positives. But the longer these numbers maintain, the higher the generally higher level of interest rates we might expect. But all this growth is going on, and there's still this notion of a K-shaped economy. So while the higher income part of the marketplace is still driving much of consumer spending, so we don't see the consumer spending numbers necessarily roll over, but we certainly see that sentiment has struggled. And I think this is important to keep an eye on. But it's almost been a contraindicator in the near term as the consumer sentiment has fallen, but consumer spending continues. And I think that is just representative of the diversification or diversity in our economy today. And then when we think about what else is on the horizons, potential risks, obviously the conflict in the Middle East and its lack of it's hard to get excited about each new headline of there's a deal coming. So I think we'll know when we know. But the oil markets have been around the horn in terms of pros and cons. At some point there has been a tremendous amount of oil released, not only from our own strategic petroleum reserve, but SPRs around the world. And at some point, those are going to need to be refilled. And so the possibility of higher oil price in the future, even with resolution of the Strait of Hormuz, is I think still a risk out there that could put just a little bit of damper on long-term growth. So that's the markets and some short views. I want to transition here to some recent changes. So in the non-US equity portfolio, so as a reminder, we have multi-manager solutions that act as the building blocks for each of the standard pools within the portfolios. One of those is a non-US core equity portfolio. It owns developed markets outside the US. So that would be Europe and Asia and Canada, amongst markets that you would know and recognize, like France and the UK, Japan. Diversified multi-manager active strategy. Today, we made some changes to that portfolio late in the second quarter. Our dedicated international growth manager had been American Century. It had been American Century since the launch of the fund back in 2018. American Century had been under some performance pressure. They'd struggled for a while. That caused them to reevaluate some of their processes, and ultimately, then that led to some departures that we thought were not advantageous to the long-term success of the strategy. So we did elect to replace the strategy. We replaced it with 2 more concentrative active international managers. So Hardman Johnston and WCM. We went with 2 growth-oriented managers, and I'll talk more about that in a minute, to go alongside Arrow Street, which is our core quantitative strategy, and LSV International Value, which is our dedicated value strategy. Hardman Johnson going to own a portfolio of 30 to 50 names. They're going to be concentrated on higher quality companies. Basically, they're going to be looking for sustainable growth rates. They want to get those at more attractive valuations, and those are companies that are going to have stronger balance sheets, lower debt loads. Basically, good, solid, long-term compounders is what Hardman Johnson is after. We've paired that with WCM focused international opportunities, which is an all cap strategy where they are really focused on if you will, the leading edge of the growth curve. They want to own companies that have a higher growth rate and maybe have the next new opportunity to grow at a higher trajectory. We want that both of these strategies are designed to create long-term higher excess returns. WCM probably would be the highest excess return, if you will, just based on its strategy of the group internally. But we found that pairing the two together with the existing managers helped us to keep our overall risk targets where they are in the overall portfolio. So when we look at how they line together in terms of strategy, so ArrowStreet, again, EFA is just basically the entire developed world ex-Canada. World ex-US is EFA plus Canada. So it's again, developed non-US markets. These are all highly rated managers. We do put a T rating for a manager in our manager research group. Just means it's going to have tracking error. That means it's going to vary more regularly from its benchmark. Or let me say differently, it's going to act differently both up and down relative to its benchmark. So when we think about creating overall portfolio construction to deliver the risk profile we're after, pairing off these two managers at smaller allocations actually helps us better control risk without giving up the return. So I talked a little bit about what they each do, and we wanted to provide just a little bit of color as we think about, when we pair managers together, we want them to perform differently at different parts of the market cycle. So ArrowStreet will do best in a trending market. It's a quantitative strategy. It tends to do poorly or underperform in short-term changes in direction because their model just can't catch up. But they do catch trending markets extraordinarily well. It's actually one of the best performing managers in this strategy and in your entire complex over the whole time that we've worked together. So we pair that with LSV, which focuses on more traditional value type strategies. They're going to do better in an inflationary environment. They're going to do better when cyclical businesses are rewarded because cyclical businesses tend to carry lower valuations. And as we have seen more recently, value has really carried the day outside the US. Absolute returns and returns relative to the benchmark have been much stronger for LSV. They're going to be more at risk of underperformance if there are high growth businesses or extended market rallies where valuations get stretched or investors, the strength of the rally is such that investors start to pay less attention to valuations. And the flip side of that, if you will, or if the companion side of that is the allocation that WCM and Hardman Johnston now sit in, where in a strong market expansion or extended rally, we would expect both WCM and Hardman Johnston to outperform. They'll do better at different stages of that rally, but together over the course of the rally, we would expect them to do well. And then again, in an environment like we talked about earlier, where maybe there were substantial changes in expectations or higher valuation, higher flying stock sell off, we would expect them to do less well. And so the combination of those four managers together, we think raises a probability. Again, I talked a little bit about why two managers. That it really is about pairing good quality risk control with long-term return potential to continue the success of this fund that we've been fortunate to create since the launch back in 2018. Excuse me. Sorry, I'm in the Northwest and the state is on fire, so the smoke is getting to me these days. Okay. So we'll transition from there and we'll talk about the investment performance for the standard pool. So as you might imagine, in a period like we saw with the broader markets, all the standard pools generated excess returns for the quarter. We see good solid returns from our money market option that's now up just about 2%, just shy of 2% on a year-to-date basis. Low duration fixed income, as we have seen rates move higher over the course of the year. Not quite as strong, but still positive and a good solid quarter, relatively speaking. All of the intermediate and longer term pools, anything that owned equity, really, again, posted pretty outstanding returns. And in most years, we would be happy with these type of double-digit returns, and yet we got them in the quarter. As we would expect, the public-only investments, so really the ESG and North on the list here, much stronger performance because they are fully exposed to public equity markets. And so in the environment that we saw, saw really good, solid performance, and really amongst pretty similar returns for the quarter for each of those, and small premiums against their policy indexes. You can see, as you'll recall, first quarter was a little less ebullient. So what that strong quarter meant was it's still a really pretty decent year to date of up nearly 10% for the passive long-term growth and active long-term growth. ESG had a much tougher quarter. It tends to do better in the risk-on environment. So an environment like we saw in the second quarter, the strategies that it owns tends to generate more opportunity for premium in those risk-on environments, and certainly in the first quarter that was not the case, and so we had a little bit of underperformance in the first quarter. Diversified long-term growth, again, because it owns some private capital, right? That private capital doesn't react as quickly to changes in the marketplace, so we get a little bit of underperformance there. That's really the primary difference. I don't want to, let me rephrase that. I want to say that's underperformance. It's different performance in the short term than our public onlys, but you can see even over the course of the year to date, pretty competitive. And we can see over time in the weaker markets, particularly back in 2022, when equity markets were off by a lot, diversified long-term growth, higher level diversification provided some benefit, and in the rebound period of 2023, it gave a little bit of that back. So this diversified long-term growth ride should be, particularly versus its long-only peers in the same part of the risk curve, should be a little bit more. Should be a smoother ride, if you will, less quarter-to-quarter variation relative to the others, but still driving towards that same long-term return of the public-only markets. And again, back to circling back, Stephen, to your question on should there be fear, that in the event of a market sell-off that was driven maybe by that concentration, we would expect passive and ALTG and ESLTG to underperform the diversified long-term growth strategy, for the periods of the sell-off, because DLTG just has less direct daily exposure to those same kinds of risk factors. So I will stop there with my formal remarks and take any questions.
Great, Travis. Maybe we can just focus this back to maybe something that's on the mind of a lot of our fund holders is, we're hearing that, the consumer is struggling. If you watch the news, there's a lot of bad news out there, and the markets have done so well for so long since 2022. Maybe speak to someone that, has money in a money market or cash or something and wants to get in and wants to invest for the long term. And is it, a bad time to do it because we're at all-time highs, or, just thinking about your time horizon in the long term, maybe just some comments on, the power of long-term investing and keeping up with inflation versus, I feel like we always have that, bug in our head of, I don't want to, invest a day before a 2008 or, a market crash. And, we can never predict that, but maybe just some comments from a macro perspective that can help some of our fund holders and board members and things of that nature. And just a reminder, if anyone has any other questions, please feel free to put them in the chat. But maybe that'll give you something to chew on for a minute or two, Travis, if you just want to touch on that.
That's a great question. So if you've been under risked, to use a fancy term, right? If you've been more deployed to cash or maybe bonds, short-term bonds, and that's not consistent with your long-term horizon. So I think that's first and foremost. I think that's the important question. If you've been holding cash and bonds because you're going to need that money in the next 24 months, then that's probably not a bad choice, because particularly if you need the money, I tend to be a classicist on this in the score. If you know you need the money in 12 months and you know exactly how much money you need, holding that money in cash for the next 12 months is that's not a bad choice. Because we don't know what could happen. Now, the market could double in the next 12 months, and so you had some opportunity cost. But if it halves, to your point, then you don't have the money necessarily. You may not have the money that you need to spend, or to raise the money that you need to spend could really do some major damage to your portfolio, because you have to raise all that money, particularly if it's a large relative amount of money to your portfolio. So presuming that you do have a longer time horizon, but you've just been under risked, then it's a tough thing to consider, because we don't want to necessarily step in front of a speeding truck and get run over. And so we generally take the view that if you want to start to get back in, there is no perfect time, and B, if you're sensitive to that perfect time risk, there's nothing wrong with dollar cost averaging back into the portfolio. So, 3 months, 6 months, I don't think there's any magic time. Some of it, this is really ultimately about feel and comfort and uh, utility function, to throw out a fancy economic word, right? Ultimately, any downturn you feel, as behavioral science would tell us, any downturn you feel, you're going to feel that a lot more than if you got it perfectly right. And so, again, it's weighing off that comfort level with your investment portfolio with the potential of opportunity cost, right? If you can live with opportunity cost, then dollar cost averaging is probably a good solution for you. But it's not an easy question to answer. It's not the same. The answer is not the same for everyone. Our basic take though is, if you're under risked or you get a big cash infusion, maybe, then, ultimately we don't know what's going to happen tomorrow. Valuations in some parts of the marketplace and certainly in indices are perhaps stretched, and we just saw really tremendous returns over a very short period of time. That kind of volatility just suggests that some caution is probably warranted, and so 3 to 6 months of dollar cost averaging is a very reasonable solution for that. It still could end up wrong in the sense that the timing doesn't work to your favor, but it's a reasonable solution to potential volatility if you have cash to put to work.
Yeah, I think that's great advice. Being systematic. I think a lot of what we're trying to do is take the emotions out of investing, right? And if you're going to buy in 3 months, 6 months, 9 months, then you kind of do it whether or not the market is up or down.
Right.
So that's great advice. I don't think we have any other questions. I think we can leave it there if you have any other closing remarks or anything, Travis. But I think this was great content. I mean, we've talked about concentration in the S&P 500 and going down to small and mid, and you talked about emerging markets. I think two companies are 40% of that. So I mean, you even look in some other areas, and concentration is even broader than it is in some areas. So really appreciate your time, and this is great information. And if there's any other follow-ups, we're all available for questions. So thanks for your time today, everyone.
Excellent. Thanks, Stephen. Thanks, everybody.